Gold has historically been considered money, while everything else is often viewed as credit. Since 1971, however, gold has been significantly demonetized. It's striking to look at the historical data. Back in 1971, when we're on a gold standard, albeit an imperfect one, you could take the total money supply and divide it by the 261 million ounces of gold we had. This calculation would give you a gold price close to $35 an ounce, which was the reference price from Bretton Woods. If you apply the same calculation today, given the vast increase in the money supply, gold would need to be priced at around $90,000 an ounce to maintain the same value reference. This stark difference highlights the massive amount of money that has been printed since then. It's interesting to note that while gold-S monetary premium has diminished over time, Bitcoin advocates often argue that gold-S monetary premium is too high and will continue to shrink. This perspective underscores the fundamental shift in how we view and use money in the modern financial system.
Gold has long been considered a form of money, while other assets are typically seen as credit. However, since 1971, when the U.S. fully transitioned off the gold standard, gold has experienced significant demonetization. It's quite revealing to examine the historical data in this context. Back in 1971, the gold standard was in place, albeit imperfectly. By taking the total money supply and dividing it by the 261 million ounces of gold held, you would find that gold was priced around $35 an ounce, which was consistent with the Bretton Woods reference price. If you apply the same calculation today, considering the massive expansion of the money supply over the decades, gold would need to be priced at approximately $90,000 an ounce to reflect the same monetary value as in 1971. This dramatic increase illustrates just how much money has been printed and devalued over the years. It's a clear indication of the erosion of gold-S role as money due to the relentless increase in the money supply. When Bitcoin enthusiasts argue that gold's monetary premium is excessive and will continue to decline, they're highlighting a significant shift in the monetary landscape. The traditional view of gold as a stable store of value is being challenged by the rise of Bitcoin, which offers an alternative form of money that is less susceptible to inflation and devaluation. This shift reflects broader changes in how we perceive and utilize money in the modern financial system.
Subscribe our channel and press the bell button to get our video notification. And like the video.
When it comes to choosing between assets, Bitcoin would be my top pick with gold as a secondary option. As we move forward, it's crucial to adopt a more responsible approach, including setting limits on money printing. However, implementing such measures will undoubtedly come with significant challenges. The current situation feels a lot like we have at a massive party and indulging in excessive money printing and financial expansion. Now, we're facing the inevitable hangover. The reality is that there's no easy way out of this. The consequences of addressing these imbalances will involve some pain. We need to face up to the fact that after a prolonged period of fiscal and monetary excess, correcting course will be difficult. The process of sobering up from our financial overindulgence is going to be tough, but it's a necessary part of realigning our economic practices with more sustainable and responsible policies.
When considering asset preferences, Bitcoin would be my primary choice, with gold as a close second. Moving forward, it's crucial to adopt a more responsible approach, which includes setting clear limits and caps on money printing. Implementing these changes is essential, but it's important to recognize that doing so will likely involve significant challenges and discomfort. The current financial landscape feels much like we've been in an extravagant party, one characterized by excessive money printing and fiscal expansion. Now, we're refacing the inevitable hangover from this overindulgence. The reality is that there is no way to avoid the consequences of our past excesses. Correcting these imbalances will bring about some degree of pain and adjustment. As we transition from this period of economic overextension, we need to sober up and confront the reality of the situation. The process will be challenging, as we have enjoyed a long period of financial and monetary expansion. Now, it's time to address these issues and implement more disciplined and sustainable economic practices. This means facing up to the necessary adjustments and understanding that they are crucial for restoring balance and ensuring long-term stability. While it won't be easy, making these changes is essential for navigating the current financial landscape and building a more stable future.
The history of derivative markets shows that governments have often intervened, especially when money printing becomes a concern. In the context of Bitcoin, there is a potential risk if derivative markets around it grow significantly. If derivatives linked to Bitcoin were to become substantial, there's a possibility that government intervention could occur to mitigate risks or stabilize the market. Currently, there is no clear evidence of such intervention. The volumes of Bitcoin futures and options are still relatively small compared to gold, which has a much larger and more developed derivatives market. The trading volumes of Bitcoin derivatives are trivial compared to the total amount of Bitcoin in circulation and the underlying trading activity. Despite this, the high volatility of Bitcoin, where the asset can potentially double in value in just a few months, means that if derivatives become more significant, regulatory scrutiny could increase. Those dealing in Bitcoin derivatives need to be prepared for significant fluctuations. If not properly managed, the risk of substantial losses is high, which could quickly put investors in a difficult position if the market turns against them.
The history of derivative markets reveals that governments have frequently intervened, particularly in times of extensive money printing or financial instability. As Bitcoin's derivative markets grow, there's a potential risk that governments could step in to regulate or neutralize these instruments to manage systemic risks. However, at present, there is no concrete evidence of such government intervention in Bitcoin derivatives. The trading volumes of Bitcoin futures and options are still relatively minor compared to those of gold. Gold has a well-established and highly liquid derivatives market, whereas Bitcoin ES derivatives market is still in its early stages. The volumes and size of Bitcoin derivatives are trivial in comparison to the total amount of Bitcoin traded and the underlying asset. That said, the inherent volatility of Bitcoin, where the asset can experience dramatic price swings, such as doubling in value within a few months, underscores the potential risks. If Bitcoin derivatives become more prominent and widely traded, regulatory oversight might increase. Traders in Bitcoin derivatives must be cautious and prepared for substantial market fluctuations. Without effective risk management, there's a significant risk of losses, which could quickly lead to severe financial consequences if the market moves unfavorably. As such, while government intervention is not currently evident, the potential for it exists as the market for Bitcoin derivatives evolves.
Subscribe our channel and press the bell button to get our video notification. And like the video.